My name is Jesse Durham, and I help people live and leave a lasting legacy. Hello and welcome to the Durham Talents channel. I'm getting set up for a conversation with my buddy Joe today. It started out we were going to have a phone call about annuities. And I asked him if we could just go ahead and hit record so that we could have the conversation. And it was great. There's already going to be a part 2. I'll tell you now. We agreed that this is going to take more than one sit down. And of course, I'm particularly interested in how annuities can play into an individual's life that's implemented infinite banking. We had a great time, and I hope that you enjoyed.
But you were questioning about annuities. I'm like, I'm in favor of them. Nash was not, and I can go through what that looks like and all. But yeah, what's on your mind with it? What do you want to know?
Do this for me. Pretend that I know nothing about annuities and give me your high-level look at it, if you would.
All right. So I think normally I would relate this topic of annuities to something people do know. So people or at least they have seen their parents get something like Social Security. And they see that their parents receive a paycheck every month. Well, without fail. Comes in every month. Doesn't matter if they invested or not. It doesn't matter if the market was up or down. It doesn't matter. The contract is they're going to get this payment every month. And that just keeps coming in. That income stream, the fancy word for that is annuity. So some people will have pensions. Like we'll have probably discussed their finances before this, but maybe they have a pension. I'll relate it to that as a private pension would be you purchasing an annuity. At some point, it's going to be an income stream for life that you cannot outlive. And that's the primary purpose of it. A cash flow you cannot outlive. That will not stop as long as you keep waking up. I think the very first annuity, I forget the names now, but it was a lady signed the contract with a lawyer and said, hey, I'll give you all this money. You just keep paying me whatever it was, $1,000, $2,000 a month. She outlived him, but his estate had to keep paying him. She was like 115, something crazy like that. So she won on that deal. But yeah, it's just this idea that usually way back in the day, there was a single breadwinner. And if that role disappears, what happens to the family? So it's kind of like, let's create a contract that we can pay that, we can use premium dollars to then at some point in the future, pay them for the rest of their life as if that person was still here, generating this cash flow. It's kind of like the idea. It's like the other bookend to life insurance. This is if you die too early. This is if you live too long and you don't have any assets left. That makes sense.
The historical, I'll jump in just because you took a big breath right there. The historical thing that comes to mind is, so I enjoy reading to our children, and some books that I'm holding in reserve currently are, say, some Jane Austen books, where it's talking, in England, where the context will be, well, when you find the old money in the story, it'll be said that, oh, well, such and such family have such and such number, of pounds per month. So they're an old money family because they've got this annuity or they've got this cash flow that they inherited, right? That it's just coming to them, etc. And that jumped into my mind.
Yeah, that's really good. I think another way to relate this to people, like a lot of people are in real estate, you could think of it like you bought a property and this is the rents, the profit that you earn every month. Except there's no, changing unclogging toilets, no annoying tenants, no vacancies, no missed payments, it just pays. Truly passive for the rest of your life. You sign the contract, from that point forward, it's in force.
All right, so tell me what other characteristics then stick out to you as far as risk, maybe, or overhead. I'm starting to use some of my own words, but I don't want to say much. Like, it's easy for me to talk in the context of properly structured whole life policies that they have this and that and the other characteristic to them. So what would you say are the characteristics, in your own words, of an annuity?
Yeah, generally there's deferred annuities and immediate. So I want the income stream to start now or sometime in the future, past past a year, past 2 years, past 5 years, right? Deferred, immediate, like within 13 days, I need this money starting. Okay, so there's the general overarching, and within those, there are like there's also two phases I kind of hinted towards. It's easier to see with the deferral, but even the immediate has a short period of deferral. Like you can't just get it in day one. So it literally is something like 13 days. You have to wait to start. So there's the kind of, I guess you could call it the deferral stage and then the annuitization stage. The annuitization is the income stream we all love. While it's in this deferral, it can be either something like a fixed instrument, like a CD, that like every 3 years it just renews at whatever rate and just keeps trying to compound at that rate, or it can be invested in something like a sub account, like a mutual fund. It's not a mutual fund, but it works a lot like a mutual fund. So you can get people will sell that idea that you can get market exposure. So, and hopefully, if you're doing deferral for a very long period of time, you're thinking, well, obviously, I want this money in the market to compound, hopefully, for 10, 20, 30 years. And when I get to retirement, it's a much bigger transition to the annuitization phase. So the income off of this should be much higher.
All right, so let me ask, since you took me there, although you've made me think of 3 different areas or directions of questions that I want to ask. Sub-account. If it's not a mutual fund, what is it?
Well, so the technical term is sub account, but the structure, it's not a mutual fund. It's more like a unit investment trust. So you'll hear, if you ever get a proposal for this, you'll see that they'll talk in terms of units. They'll say, whereas a mutual fund uses shares a lot of times, this will be units. And over time, like a front load unit will vest to this other unit, and that represents some amount of income, right? The beauty of this product is, or one of the beauties, I'll say, if you're into the market, once your units you've traded for an income stream. We didn't talk about this yet, but the income stream could also be a variable income plan. So you have the same number of units, but they stay matched or quote unquote invested in the market. You never sell them, but if the market goes up, your income stream goes up. If the market goes down, the income stream goes down. You can't sell them. It's not an account. But you said, instead of saying I want a fixed level payment for the rest of my life, keep this like linked to the market. As the market goes up, I want my income to keep going up. So it's like a cost of living adjustment, kind of. So what fancy people in modern financial planning would do is a really big chunk would be the fixed to take care of necessary expenses in life. And then, like, let's say 80% of the value would go to that, and 20% will be in this variable. So hopefully over time, the overall is your income keeps going up.
Okay. So if this were that first lady who's going to the lawyer or whoever to get her annuity, right? You're saying whatever amount of money she had, if she decided to do and I'm trying to recall the word that you used, but a lump sum. She's trying to make a lump sum annuity. perhaps she would take 80% of that, and that would be fixed, and then 20% of the total that she's wanting to go into this type of a contract would be what would kind of ride the market, and when the market goes up, she could experience some more. Is that right?
Yes. So the common name for that in most places would be a variable income plan, VIP. So that would be that 20% that's linked, that can, right? The units never change. You're never selling. You're not rebalancing or anything like that. It's just, it's linked to the market performance. As the market rises, hopefully, as the market rises, your income will match that. I didn't say this in the beginning, but it's really important, and it's part of the disclosure requirements. When you buy an annuity contract, you're giving up that liquidity. It's gone. You can't. Now, there are certain emergency options to get that money back, but generally speaking, that's what you gave for the contract. It's like a single premium for a life insurance. You gave it, can't get it back. That's what the trade was. You got this contract now, you gave up this liquidity. So you have to be very careful not to use, like, for example, all of the assets in something like this, where if there's a liquidity need, but it's higher than the income stream, what do? They get in a pinch. Maybe they have to go to a bank for a loan or something like that. But generally, most companies would say something like 30 to 40% would be the max they want to see, like, of your liquid net worth could go into one of these products.
When someone pays money into a contract, so tell me if I've got this right or wrong, because say a Dave Ramsey, if we were having a conversation about people who decide to pay premiums into whole life insurance contracts, he'll still be using this language, and so will lots of other people and lay people, right? Saying things about your money. What do you mean? I've got to pay interest to borrow my money? So whether someone's making a deposit at a commercial bank or whether someone is making a premium payment to an insurance company, that is a voluntary move, right, of ownership of those dollars. You know, in the case of a bank is going to owe you the equivalent of what you've put in, plus any interest that they say that they will, pay in a savings account, let's say 0.005, or, whatever it is. And then same thing, an insurance company accepts your premium. It is now their money. So I'm saying, well, those are two examples that I've talked about a lot more frequently. But is that exactly what you're saying is the case with an annuity contract as well, perhaps excluding some emergency contingencies in that contract?
Yes. Yep. So
Right.
once you pay the premium, it's the premium is now the insurance company's, just like life insurance. You receive the contract and the guarantees within the contract. Yes. And we didn't touch on this yet. I don't know if it's going here, but there's indexed annuities. And there's annuities with guaranteed withdrawal riders, you could say. There's several flavors of those, to create income, but preserve. So the reason I'm going here, while you're in the deferral stage, so if you picked a deferral instead of immediate, while you're in the deferral, you can get your money back. So it's like, think of it like an investment account. So you can say, hey, I'd like to take a distribution from my contract of $10,000. They'll go in, they'll readjust all the figures of the income projections and all that, and then they'll hand you back the $10,000. And whether that's taxable or not, it really circumstantial, depends on how much you put in and so on and so forth. But depends when you're doing this. Has it been 50 years and there's like nothing but gains? Yeah, it's life insurance receives a tax favorable approach, FIFO, whereas a MEC in a life insurance is LIFO. So it's tax, right? Well, annuities start with LIFO. So it's already at a disadvantage of life insurance. It's really funny. Like if you can, as you get more familiar with this, you learn they're using virtually the same mortality tables for the life insurance contract and the annuity. They're just at a different end, different purpose.
Real quick. LIFO meaning last in, first out versus FIFO, first in, first out. So I made a note. I want to come back to that, but I also want to keep you pretty high level right here real quick. So annuities are contracts where someone could pay an initial sum or an ongoing stream. And then once they have that contract, they could decide to be in a deferral stage for a period of time, or they could go essentially virtually right into annuitization where they paid that lump sum. And okay, so why then might somebody want to be in a deferral stage?
Sure. One big reason to do this is liquidity. If they fear, if they put the maximum that the insurance company would allow, 40% of their liquid net worth is in this, and they fear they might need access to it. If they shift and make the election to annuitize the contract, that's a one-way street. Right? You can't get that liquidity anymore. Well, this is a good segue, because why would you stay there? Well, companies realizing this have come out with guaranteed withdrawal benefit riders, that type of language, where you remain in the deferral stage, but so long as you don't take unscheduled withdrawals, distributions, this rider will guarantee the distributions, a withdrawal. So it has the appearance of annuitization, but you're actually still in the deferral state. And we can flesh that out a bit more. The big problem with that is the cost of the rider. Right. So what this actually does is it says, we're going to take whatever the high watermark is, and we're going to add some percentage to it. 2, 4, 8. It depends on what your rider language is. That value that they calculate the guarantee off of just keeps going up. The actual value of the contract can go down. It can go all the way to 0. So virtually the only thing left is the rider paying it. So if for example, you pass away, there's no succession. Like you can't pass this to your wife unless she was a joint annuitant in the beginning. But like, whereas with a pension, even Social Security kind of has this mechanism built in where if the breadwinner or the person with the higher benefit passes away, they get a top off on the other person's, so they get the higher benefit, right? Or in a pension, you get like 100% survivor. Even if mom dies, dad gets 100% of that pension. Well, if you're in this deferral and the value has gone to 0, and all that's left is the rider, and the person dies, there's nothing left thereafter. The contract ends, it's over. Nothing left for dad or mom, whoever the survivor is.
So you brought up a new aspect, so let me underscore it. So it's possible for a single individual to be the annuitant, or if we're talking about a married couple, for example, they could both have their own annuities, or they could be on the same annuity.
Yes. Yep. And same with ownership. Like annuitant and owner can be different, just like the insured and the owner on an insurance company, insurance contract, sorry. You can have joint ownership, just like a life insurance company. Contract, geez, just like a life insurance company. Like mom and dad can own the policy on dad. Mom and dad can both own the policy on junior. Just like that, you can both own the annuity.
And then typically, let's say for underwriting purposes or application purposes to an annuity, it's much more prefaced around not so much, say, a health exam, a medical, a paramedical, but rather much more about, well, okay, where's your net worth at? What percentage of your net worth would you like to consider in this contract, right?
Yes. So that's why I say they kind of share the life insurance mortality. Life insurance is more judicious with how your contract is tailored to your health. An annuity is much more generic. There is no medical exam. So they're just looking at Joe, 40-year-old male. This is the rate. That's what he gets. Now the benefit, like that sounds like, well, what if Joe's really in great shape, but Jesse's not? That sucks for Joe. He gets the same payout? Not quite. There's these things called mortality credits. That's how it balances out. Mortality credits are kind of like, this is kind of a sick way to explain this, but it's like the survivor gets the remainder. If you keep living, you get all the benefits, essentially. That's why it works. That's how it works. Whereas in life, it's a little easier to understand in life insurance, where there's the distribution of ages and the probability of death at a given age. Right. So they're tailoring that. They're not tailoring it on this side. They're just saying, whoever it is, we don't know, you're going to get all the benefits. So if you're healthy, I'm healthy, Jesse's not, there's a good chance I'm going to live maybe 5, 6, 7 years longer. I'm going to get those benefits much longer.
So again, in my own words, if I said actuarially, as the insurance company is looking at the pool of folks that they have annuity contracts with, it's kind of like a reverse mirror image of the folks that they have life insurance contracts with, meaning, well, we don't know when you're going to die. We might have a good idea in general as we look at this pool. So yes, we offer you this contract for this amount of death benefit, etc. Whereas on the other side, there's this stream of income coming to that pool of annuitants or owners of the annuity, whatever that relationship is. And people are also going to die at different times. So the people that don't live as long receive the income for whatever time they do, and the people that live longer. But it's actuarial science again, also, but just in a different perspective.
Perfect. It's mirror image. So on one side, life insurance typically receives the income and has a big pool that they have to pay out benefits from. On this side, they receive the pool. Remember, you're giving them the money up front, and they know they can shoot out this much for 120 years.
I like the way you said it. I like the way you just said that right there. That made sense to me. Stream of premiums holding the pool. Over here, they get a pool, and then they're giving out streams of income. I like it. That's a good visual for me. Okay. Listen, I'm surprised that you've constrained yourself to just speak with me thus far. I definitely expected that you'd share something or jump in. All right, let me still stay high level. Make sure I'm firing on all cylinders here. Deferred or annuitize. I still want to circle back, I think, to the characteristics. Boy, we went down like a rabbit hole that led to a rabbit hole that led to a rabbit hole. And I can see that because I'm taking notes, and then I'm drawing arrows and in different directions to show that, well, there's this, but then there's that. So circle back to the top for me. Okay, you got something. Go ahead.
Yes, I was just going to say, we mentioned the medical. There is no medical. There is, however, a beneficiary, typically. On the contract, they will give you the option of a beneficiary. There is a death benefit. It is not, like we said, we're on the other side of the scale here. We're on the mirror image. It is not income tax free like life insurance. It is taxable. But there is a death benefit. So, for example, a great planning opportunity, if someone, could not find insurable interest, could not get it on themselves, they can use the death benefit. So if someone could not find insurable interest, could not get it on themselves, they can use the death benefit. So if someone could not find insurable interest, could not get it on themselves, they can use the death benefit. So if someone could not find insurable interest, could not get it on themselves, they can use the death benefit. So if someone could not find insurable interest, could not get it on themselves, they can use the death benefit. So if someone could not find insurable interest, could not get it on themselves, they can use the death benefit. So if someone could not find insurable interest, could not get it on themselves, they can use the death benefit. So if someone could not find insurable interest, could not get it on themselves, they can use the death benefit. So if someone could not find insurable interest, could not get it on themselves, they can use the death benefit. So if someone could not find insurable interest, could not get it on themselves, they can use the dea but had a sizable net worth that they didn't need this chunk for, that they could put in an annuity and just let go. There are different death benefits you can choose within the contract. For example, one of them, typically something enhanced death benefit, something or other enhanced death benefit, it'll pay out the high watermark of your contract. So for example, if the contract's in the market and it's going like this, every year they're going to say, is it higher? Okay, move the death benefit. Is it higher? Move the death benefit. Is it higher? Move the death benefit. It never goes down. So for people that like want a death benefit, they understand the fluctuations of the market. There's no way of timing it, but they figure over the long term, it's going to be a lot higher a lot later. I'll get that high watermark, that enhanced death benefit on mine, so I can leave something bigger to my family.
So are there annuities then that do have death benefits and then annuities that don't have death benefits?
Yes. So the death benefit, my apology, I should have said this. I'm still in the deferral stage. So when you go to annuitize, remember, it's all gone. All those other things are gone. You just get the income stream now. The only benefit then would be, is there a survivor? Or do you have something called a period certain on the contract, where you say, hey, insurance company, I want to make sure this pays out for 10 years for certain, whether I'm alive or not. That's what I want written in the contract. So the annuity will continue paying even if I pass for 10 years and then stop. You can do what's called a return of premium, which all of these have costs. So there's a cost benefit analysis here. But if you put $100,000, $200,000 into it, it usually makes people feel good to say, I want a period certain or a total return of premium. If I die, that pays out either in an income stream or a lump sum to my beneficiaries. So then the insurance company takes your contract, and every time they pay you, they say, okay, you gave us 200,000. We gave Jesse 2,000. His benefit, death benefit, is now 198, 196. So whatever did not get paid out will be paid in a lump sum to the beneficiary of the contract. So there's kind of a way to return the premium, but it's not necessarily a death benefit like I was just describing. The death benefit I was describing was in a deferral stage where things are still tied to the market. There's kind of an account balance, what feels like an account balance. While you're in that stage, yes, you can get that death benefit paid to a beneficiary. But in the annuitization, if you don't have the period certain or the return of premium, anything like that, or survivor, there's no transferring the value of this.
All right, I feel like I heard 3 different variations of scenarios, so maybe I'll try and repeat them back to you. So there's a death benefit when the annuitant dies or the owner, I guess, again, depending on who's got what roles, in the deferral stage. There's a death benefit that can be paid in the deferral stage. Do I have that right?
Mm-hmm.
Right. But then, or there may be a period certain option where the owner is saying, well, whether I live or die, I want this monthly stream of income to me or my heirs, obviously, or whoever I designate, for the 10 years that this contract represents.
Yep.
Okay. And then, or again, you can have this return of premium option to where the agreement, the contract, the annuity is for that $100,000 like you mentioned, and let's say only a month of $2,000 was paid before that person dies, and then there can still be a return of the other premium that was not able to be used by the insurance company, so they'll just pay the remaining $98,000 because they've already paid the $2,000 to the designated beneficiary. Okay, cool. Awesome.
You are an expert, man.
It made me want to. Oh, it made me think of another real high level question. Let me see if I can recall this one. Oh, all right. So, entrepreneurs, business owners, Joe, I guess I'm just trying to think about these kinds of folks that are used to having a lot of control over the direction of their money, having tight hands on the decisions around their money. I feel like people can hear about annuities and have a big sense of, well, okay, I see there are guarantees. I see that these insurance companies have great track records, so they're quality institutions, obviously, and they can see all the pros, but then maybe they have this hesitation of, but I'm a business owner, or I have been a business owner. Because again, we're time of life comes into this type of a conversation for sure. There may or may not be the case for a 30-something-year-old to be considering an annuity, but there could be for a 50-something-year-old, 60-something-year-old. So I'm not trying to get real particular right there, but I hope you're getting a feel for what I'm saying. People that are used to having a tight control over their money, and they're making, they're mobile with their money and things like that. Give me any feedback on who, and people should pick for themselves, but I'm trying to tap into your experience here and your thoughts. Who should be considering annuities in general?
I would say if you underscore that with the infinite banking concept.
And I definitely want to go there. It's a very different thing, like you say, to just put on a modern financial hat and talk about annuities versus, oh yeah, I mean, big picture, I always want to come back to that foundation of, yeah, how's this going to play into somebody who's implemented infinite banking? But I kind of want both of those perspectives. So I've not necessarily gone there myself yet.
I think, well, the reason I go there first, if you think about life insurance, the way it's used in the infinite banking concept as the platform to do the investing and do the spending from, it makes sense to treat an annuity just like you would treat a rental. It makes sense to say, oh, my money came to this platform and I chose to buy that annuity. That was one of my investments. And I got other cash flow that replenished, and I go do this investment and that investment. If you try and shift the priority, the rank order will say, I'm going to put 40% of what I have into the annuity, your hands are shackled. So the business owner is not going to like that. They can get liquidity during deferral periods. And I've seen people make poor long-term decisions to preserve that, to preserve the liquidity in the deferral phase. Instead of saying it shouldn't have gone here first, I should have thought this out further, and life insurance should have been first. This should have been purchased with life insurance. And then either when that starts spitting off income, can help repay the loan, or my other ventures can repay the loan, and I still have all my working capital free, clear, ready to go. Right. So I think Nelson was really big on this, and I don't think many people hit on this much. The primary residence of all your capital and equity should be this. So it goes out, does the thing, but the job is to get it back here. That's great. You still have those other things, but we want all the value here. We want all the capital here because it's the friendly environment. It's the most favorable, best place where your capital will be treated with the utmost respect. And you have control. Why would you want it anywhere else? So the job is to send it out, do the investment, do the buying, do that, and get it back. Get it back home. We want to come home. So I think on face value, will a business owner like this? They won't especially early in life when they're still in the business building phase. I think when they transition and say, I'm in this phase where I'm looking for succession plan. I want to get out of the business. I want to sell the business. Can this be part of the picture where they're like, I'm so used to getting $10,000 a month. What am I going to do? I have this pile, but how do I turn that? Sure, that could be part of the solution. That might make sense. But like, as long as they're operating the business and they're not going to like locking up 10, 20, 30, 40% of their money, their net worth, and seeing it on their balance sheet, but not being able to touch it and not being able to collateralize it and not being able to like, yeah, they're not going to like that, in my opinion.
You've brought up a couple of very real life things, and I know because I was on the phone the other day with a guy, and he's later in life. He's a bit older than I am. Let's call it 50s, and so still quite young, but he's done big things in the business world, done really well for himself, and he actually threw a number by me. He said, you know, Jesse, I am to the point to where, you know, I know my numbers currently at least, and it's got to be 25,000 a month. That's what I'm going to have, right? And he is looking to do less in his business. You know, built a team, built a good name for himself, all these different things, and he's gotten dialed in on that number where he knows what he expects to come in, kind of no matter what. So what I'm saying is that's a real thing for business owners or folks who have done some, or investors. They expect a certain revenue stream. I think that's something worthwhile to explore. So that's why I'm just trying to reiterate that for people that are listening, and for me. It's good. This is good conversation. And then that's the second time also that you talked about looking at an annuity like a rental property. That really helps me. So if I painted this picture, you tell me if I'm on the right track. And again, especially for somebody who has implemented infinite banking. So they've implemented infinite banking. Let's say they've got a few policies and they've used policies for who knows what, whatever they chose, but maybe that's where they've built their long-term reserve capital, their emergency fund, their contingency fund, whatever you want to call that in their life, right? Perhaps they're using it for some lifestyle choices, whether that's financing children's college or buying their cars that way, whatever the case may be. They may also be even doing some investing. All right, so quick question, then I'm going to return back to my scenario here. Is an annuity an investment?
Is an annuity an investment? It's still a risk product. So I'm going to say first and foremost, no. I think the water gets muddy when we're in the deferral phase and we're talking market-based sub-accounts. It can feel a lot like an investment. And in fact, you need to have, like the advisor needs to have the licensing as if it was an investment. So it kind of blends, it merges the risk side of the world and the investment side of the world. The really odd part, we didn't really talk about this, and we don't, you know, it's another type of deferral annuity that's indexed. You probably heard of indexed universal life, IUL, where there's indexed annuities. And those indexed annuities are also in the deferral stage. They're linked to the market through options, which is it's a really fancy derivative of the general marketplace. But that, you do not need any special licensing. The 2 out of the 3 options, you don't need anything more than a life insurance license. Whereas the one that has the sub-accounts.
Go ahead and name the 3 then, again, just
to
underscore.
So the fixed, we have the fixed, we have the market sub-accounts, and then we have the indexed sub-accounts.
And then say again which 2 out of the 3 and which not.
Yeah, so 2 out of the 3, meaning the fixed and the index, do not require special licensing or really training at this point in time.
The fixed and the indexed do not require the licensing, but the sub-account one does.
Does. If you see variable annuity, variable something, that's that market-based one. You're actually your sub-accounts are subject to the same losses and such as the market.
So people that are familiar with life insurance maybe to a better degree than most because of infinite banking probably have heard of whole life, term life, and then the various types of universal variable being one of those because of the tie to the market. All right, so let me still try and keep you at arm's length because that's also the second time that you've mentioned the indexed annuities. But let me go back to my scenario. I was describing somebody, I guess I was trying to build a case study in my mind, but I can't even remember now where I was at because I had that quick question on, is an annuity an investment? And that's where I'm at, and in my understanding anyway, is that, well, no, an annuity is a contract, like life insurance is a contract because it's a product coming from an insurance company. But depending on what your contract says, there may or may not be elements of risk. Okay. So a fair recap then. Good.
You had, before that, you were talking to business owner, and then you were like, well, then what, yeah, basically who would? Who would consider an annuity? I said, I think the person having trouble with insurability that wants a death benefit, that has a long time horizon, like they're personally worried about a long lifetime, living a really long lifetime, but for whatever reason, the insurance companies disagree and won't give you life insurance. They probably have life insurance through work, but it ends when you leave, so it's not portable. And they're sitting here like, well, I don't want nothing for the next generation, and I don't want to have to worry that what I don't spend goes to them, like this zero-sum game. I still want to live my life, but if I could just earmark this and let it do what it's going to do, and that be the legacy, then I could just live off of this and not with no worries at all.
Right. And again, that's maybe where you mentioned the whole 30% to 40% max comes into play. Okay, so I remember where I was in painting my scenario too. Remember we were talking about if somebody's implemented infinite banking, maybe they've got a few policies, they've built an emergency fund there, they're financing things with their system of policies. At what stage, I guess in life does someone consider, okay, maybe I've got some outstanding loan balances because I'm actively doing infinite banking. I've been generating or creating this rising net worth just with my life insurance policies, heaven forbid, but worst case scenario, I go today, there's a big number that goes to my families currently. Maybe they do or don't have a trust in place. So I'm just saying, talking about annuities is not necessarily the place that Jesse needed to be 10 years ago when I was getting my first policy to pay off bad consumer debt. You know what I'm saying? But now, 10 years into the game, I have used policies for financing cars, financing vacations, financing taxes that we pay in different things. We've continued to build a system. We've got 7 policies that we own, and annuities get more and more on my radar. I turned 40 this month, actually, and thank you, my friend.
Here's big man shit.
I appreciate you. And I have 3 children currently, so I'm trying to think big picture. I'm trying to think long range, and I even want to go back to what you were starting to say earlier about long range versus, because I wanted to ask you about Nelson's first principle in the context of looking at annuities and which type to pick, because you were talking about that individual that maybe was thinking a little too short term. So I even want to go there. I want to get more feedback from you there, but I'm trying to gauge when annuities come into someone's infinite banking journey, or when they could come in.
So this is perfect. I only had 2 more topics to bring up, and this is a great segue into one of them. I mentioned it before, I slipped under the radar, but mortality credits earlier in our conversation. I just want to explain that real quick, that a lot of contracts, when you start the contract, your mortality is locked in there. So most companies will say, when you get to the point you want to annuitize, presumably 20, 30, 40 years from now, we're going to look at the actuarial payout at that time and when you first started and say which one's better for Jesse. Most likely when you were younger. So they'll give you the best. If it happens to be the new one, then they'll just keep it as is. But they're going to compare and say, if you start the annuity, it doesn't necessarily have to be fully funded. Like you don't have to put your last dollar in when you're 30 years old or 20 or 25. But if you start it, it locks in the mortality at that point in time. Those mortality tables will then be compared to when you turn 60 or whenever you decide you want to receive income for the rest of your life. And they'll say, which one's better for Jesse? We're going to give Jesse those tables payout. So when should you start? I think we need to break up your question to say starting an annuity or several annuities versus fully funding the annuities. Remember, it doesn't have to be a lump sum. You can pay in over time. So starting the contract to lock in the mortality, there could be an argument starting that real early, earlier than one might expect. Fully funding it, sure, after you have businesses and real estate and you're financing left and right, you've got tons of cash value and you're looking for areas to bolster your income, what is passive income phase? Well, I already called this the ultimate passive income. It's the same, it's the mirror image of the life insurance contract. It's the same passive income. It's contractual. You don't have to do anything except sign the dotted line. So that could be kind of a place, what does he say? Make room for windfalls. That could be a place to say, if there is no more life insurance premium, another good option would be like, well, did I have one of these annuities laying around that I could add more premium to lift the future income? Why might we do that? Remember, we want all the equity in the life insurance. So if you can't put any more in the life insurance for whatever reason, and you put it here, meaning the income, the guaranteed income floor in your life just got pushed up significantly, you don't have to take anything out of the life insurance, or you don't have to take as much out of the life insurance, which preserves that for the next generation. It preserves your liquidity and the growth trajectory it's currently on long term. And it's a bigger legacy. But I just wanted to add one other idea here. We're talking about kind of when to fund, how to fund, that type of thing. You could do this real estate people, I mentioned it twice already. You could do this 1031 exchange for one property to another without, messing with taxes. There's a little degree of complexity we're adding there, but you can do something similar with these contracts and say, for example, you can go from annuity to annuity, or from life insurance to life insurance, or from life insurance to annuity, or from annuity to long-term care insurance. So we can use the annuity, even if maybe you have so much income coming in, you don't even need the annuity income, but it makes more sense in terms of paying the premium of your long-term care insurance if you go down that rabbit hole. So now you've kind of built this moat around your empire here, where you've got contracts supporting the foundation, life insurance being the foundation, annuities and income, long-term care preserving your health care. You don't need to drain all of your assets, sell off assets in a fire sale to pay for medical costs. Just some planning ideas. But yeah, when would you want to buy it versus when do you want to fully fund it? I think fully fund it, you would want to talk with your advisors and see, like I'll use Warren Buffett as an example. They were criticizing him for every century. They criticize him every century, every decade. They criticize him. oh, why does he have so much cash? Why does he have so much cash? And then the world melts down. He comes in and buys everything on the cheap. Well, it's like, if you have so much cash, this could be an area where you can kind of utilize with some foresight to say, I know in 20 years, I'm going to need cash flow. I don't want to drain the life insurance. I don't want to drain the foundation. That is the best asset to transfer. Let's preserve that at all costs. If I can't build that up anymore, and I can't build anything on my kids or grandkids anymore, start building up my income so I don't have to take it out of the life insurance, so they get the maximum waterfall. They get the maximum seed for the next generation, so they can do maximum potential on the next generation. Just some ideas.
I've written some statements down, but I've written some more questions down. I want to know more about this locking in an annuity. I want to know more about what it looks like to fully fund an annuity. I want to talk more about those exchanges. I want to talk about deeper into when one should consider getting an annuity, and even most importantly, go back to that scenario that I was painting earlier and use that just as some kind of a reference, some type of a guide to get some principles around what it looks like to implement annuities as another type of contract in the life where you're your own banker, where you're doing infinite banking. So that's me asking for a part 2. Okay, fantastic. Fantastic. Because I'm genuinely curious. And then you even brought up the other topic of long-term care, which is something that I've been spending more of my personal time watching about, reading about, etc. So that's another thing that you've brought it up. I'd like us to field a conversation around that as well. Yeah, any closing thoughts for now that we know that we're going to have a part 2?
No. I look forward to it. I think adding in, how come there's no mech on this side if it's the other side of the life insurance into the equation might be a good little subtopic there. Why didn't Nelson like annuities? What did he say about annuities? That'd be a nice little segue back into the IBC Foundation.
Awesome. Well, let me just go ahead and say another big thank you to Joe, because we just talked about having a conversation today, but as per usual, we hit record for the benefit of sharing our conversations with you. So if you've had a big takeaway or you have a question about annuities, make sure to put that in the comment section below. Also in the description, you'll be able to find Joe DeFazio's contact information. If you'd like to reach out to him, you can always find me at DurhamTalents.com. Live and leave a lasting legacy.